In the American housing market, there is a long-standing economic rule. A brand new home with the latest finishings commands a premium over an older, existing property. It is the baseline logic of real estate. This chart tracks that logic over time. The blue line represents new builds, and the white line tracks existing homes. Usually they move in parallel, but for the first time in modern record-keeping, those lines have crossed. The median price for a new home has dropped to $402,000, while existing homes have climbed to $435,000. This inversion is an outlier. Even in 2005, right before the housing bubble burst and prices collapsed, new homes still cost more than the existing stock. On the surface, this looks like a rare opportunity for buyers. However, these specific median prices do not account for the trade-offs happening behind the scenes. To understand why new homes appear cheaper today, we have to look at the corporate mechanisms currently holding the market in this state. The shift began in March 2020. To stabilize the economy, the Federal Reserve implemented the largest interest rate cut in history, causing mortgage rates to drop to record lows. This chart shows where those rates settled for the public. Today, 76% of all American mortgages are locked in at 4% or lower. The largest single chunk of those loans is concentrated right between 2.75 and 3%. This created the golden handcuff scenario. If these owners sell today, they lose that 3% rate and must borrow at current rates of roughly 6.6%. For most, that move would instantly double their monthly interest costs. Because homeowners are staying put to keep their low rates, the supply of existing houses has evaporated. The market is now so skewed that 1 out of every 3 homes listed for sale in America is a brand new construction. With existing owners paralyzed, prospective buyers are being funneled into a market dominated almost entirely by corporate home builders. These builders are facing their own crisis. They have massive inventory to sell, but because mortgage rates are so high, overall housing affordability has reached lows not seen since 1986. To find buyers, builders are turning to 2 specific tactics. The first is physical. They are shrinking the houses. Over the last few years, the median size of a new home has dropped from nearly 2,000 square feet to just 1,792. The second tactic is a financial maneuver called a mortgage rate buy-down. Instead of cutting the sticker price of the house, the builder pays the bank to lower the buyer's interest rate for them. This chart shows why they prefer this. On a $500,000 home, a builder would have to cut the price by $65,000 to lower the buyer's monthly payment to an affordable level. But by using a rate buy-down, they can give the buyer that same monthly payment for only $16,000. It allows the builder to keep their profit margins intact while appearing to offer a discount. This means new home prices haven't actually dropped below existing homes in a like-for-like comparison. This pricing inversion is a manufactured result of smaller houses and hidden corporate subsidies. Currently, the market is split between 2 realities: larger, established homes that are frozen at high prices, and smaller, subsidized new builds that are driving the recent sales data. This gridlock is being tested by a risk developing outside of housing. We are starting to see signs of distress in general consumer credit. This chart tracks subprime auto loan delinquencies. They have recently climbed past 6%, the highest level of automotive debt failure since the 2008 financial crisis. If consumers buckle under the weight of auto loans and maturing credit card debt, that financial strain will likely move into the housing sector. We can already see what a correction looks like in specific markets. In parts of coastal Florida and Austin, Texas, prices have already shifted downward by 15 to 20% as they search for a new equilibrium. History shows that extreme pricing gaps like this eventually close. This subsidized market for new homes is a signal that a broader economic rebalancing is likely on the horizon.